What's up, guys? Welcome to another Market Radar podcast. We have survived another week. ES has been pretty choppy for a while. Ever since we've hit Momo, we did call this that the likely scenario is choppiness. We're not going to get direction, but honestly, the past 2 weeks, this is way more chop than I was expecting. ES has literally gone nowhere in the last 2 weeks. We did see somewhat of a breakout on Friday, but we still haven't broken out past the chop zone. So still definitely no direction in the market. We are still bearish trend on ES. So, as our saying goes, bearish trends lead to lower prices. And that's likely what is going to happen, especially as we're seeing deflationary odds rise. To really get a big sell-off, that's what everyone's waiting for. They're waiting for the big sell-off. That's not what everyone's waiting for. A lot of people are hoping we don't get that. But so far, odds are favoring that. But to get that, we need deflation. Nothing's going to happen until we get deflation. And once deflation happens, that's when you get the classic long bond trade. So bonds going up and equities going down. The classic 60-40 protection play. And that's what we're hoping to capitalize on with triple leverage bonds when that happens. But so far, it's still stagflation. We're waiting it out, and we take it as it comes. So far, year to date, we're green in all in SPY, QQQ, IWM, and DIA. So far, good start to the year, but NASDAQ does need 50% upward move to make up for last year's loss. That is an opportunity. We'll see how it happens. It's not going to happen without a risk-on regime. But once we get risk-on, we will be taking full advantage of that. Next week, we've got a pretty big week coming up. Tuesday is Powell speaking, so keep an eye out for that. Monday, we also have Bostic speaking, so that's also important. But the main days you want to watch for are Tuesday and Thursday. Thursday, we've got CPI and jobless claims. CPI being the main one. Everyone wants to know what's going on with inflation. And bonds are signaling inflation may have peaked. We will talk about that further in the podcast.
Okay, so let's go over the two major releases this week, economic data-wise. So the first one obviously being the unemployment rate coming in lower than expected, lower than the prior print at 3.5%, signaling the labor market remains tight. Now, bird's eye view, this is obviously hawkish, right? Lower unemployment rates means the Fed has to do more to really pull the economy into a slowdown and really just get inflation under control, right? The idea that the Fed can grapple inflation without high unemployment or with low unemployment is seen as impossible. So the Fed's going to need to pretty much boost the unemployment rate to then bring inflation under control. Now, what this did spark, though, this low unemployment print, was the idea of a soft landing, right? That's what we saw in Friday's, or when this is being recorded today. So today, Friday, this price action. This is what really sparked this move here. The idea that, man, wait, the Fed might be able to pull up a soft landing. And we'll get more into that later in the podcast. But that's pretty much your reasoning behind this quick reversion off the week lows to the week highs in one trading day. Now, let's go over the second data point, which was the United States non-manufacturing PMI. This came in at 49.6, well under the estimate and actually in contraction territory. So remember, on PMI, anything under 50 is seen as a contracting environment. So again, this is telling us real simple that the non-manufacturing PMI index is now in contraction territory. So let's go over bonds. These as well came up off the lows today. They're up more than SPYs in the last week. And it's primarily again to the idea that this fallacy where the Fed can achieve the soft landing. We'll get into that again later in the podcast, but bonds are up with the market. So if you go back the last 12 to 13 months, you'll notice that there was this positive stock bond correlation to the downside, right? We saw stocks go down and bonds go down. It was just to the downside in that move, right? In that regard, that both stocks and bonds went down. But in general, the positive correlation is still kind of there, right? Stocks and bonds are moving higher today. Bonds are off their November lows, and if we look at ES, it's off their October lows. So that correlation isn't hasn't died off or burnt off just yet, and we're seeing it pretty much give us the idea again that there's this idea or there's this belief that the Fed can achieve a soft landing.
Well, so going back to that positive stock and bond correlation, is that something that you foresee happening in the long term? So if we do get a regime pivot, we get out of this stagflation, could that correlation continue?
No, I don't think so. So I think we've spoken about this quite a bit, but I think that the biggest issue that we're going to have coming out of this is the actual pivot from the Fed, and we'll talk about that in a little bit. But once we do get that directional pivot, which we're going to need, right? The bond trade or the deflation trade won't really come until the Fed pivots,
Right.
or at least the idea that the Fed is going to pivot shortly. That's when the bond trade will come to life.
Hmm.
So the Fed is going to pivot for one reason, a recession. That's the only reason they would pivot, right?
Right.
So in that scenario, equities would continue to either chop or go lower, where bonds would become a positive or a bullish. They would go into a bullish trend and become a long trade, and that would in itself de-link that positive correlation, and the correlation would start burning off rather aggressively as bonds accelerate higher, rates lower, and equities lower. Now, on the other hand, if we don't get that Fed pivot, right? We stay in this regime of stagflation. What's going to happen is the chop is going to continue, and we've spoken about this, right? Where the biggest risk in bonds in the next 5 to 6 months is chop. We were saying this back over here, right? The biggest risk we were talking about this in October, November is the bond chop, and we're even though bonds are off their lows, bonds are still at the same price they were in September.
Right. Essentially, like chop from the previous high that we had a month ago to the low
Right.
is likely it's the most likely outcome, getting chop in that range.
Right. Until we obviously see that Fed action with the pivot.
Right. And
Um,
the beauty of that outcome as well is the longer we chop under Momo, the lower Momo goes. So when we
yeah,
do
that's
finally
funny.
get
Yeah.
that deflationary pivot, we're going to have a really good entry low down and take advantage of a larger chunk of that move when it does
Yeah.
come.
Yeah. It's funny because I remember you specifically saying that earlier in October or early October when bonds were trading around or ZB was trading around 123 and Momo was all the way up at 146. And that reversion would have been an ugly reversion, have to sit through and then flip to bullish trend.
Right. Yeah, that would have been painful, and that was actually something that I was kind of worried about a little bit, just seeing that massive divergence from Momo and the price. I was kind of thinking what I think a lot of our audience was also thinking is just like, okay, like don't you miss a huge chunk of the move by
Yeah,
waiting for it? But
off the October lows, it was straight 24%.
yeah, and that's not fun missing out on that much of a move. Like, yeah, we advocate for patience, not getting FOMO, sticking to the system, and sure enough, it's playing out just as we intended. Like the beauty of it is what you'll notice after years of being with us and watching the system perform real time, you're going to notice that everything just seems to line up every time. It just lines up and it becomes the perfect trade every time.
Yeah, that's quite interesting. That alone is just, we can put that into context right here. That divergence from 24% now it has narrowed a third down to 8%. So as this chop continues, eventually that gap of 24% will just erode. And the whole fear of missing that move will just dissipate.
Yeah, exactly. So let's go into the soft landing. Can we get a soft landing? It really like I mean you guys can hate the Fed as much as the next guy, and I mean I'm not a big fan of the Fed either, but at the end of the day, you got to give them some credit. It does seem like they're playing out for a soft landing, aren't they? Like we haven't seen anything break. They did the fastest hiking cycle we've ever seen, and people still have jobs. Obviously, like it's not all rosy like it used to be, but that's to be expected. But there's not chaos everywhere. Nothing really broke. So can we get a soft landing?
So yeah, that's I'm feeling the same way with you, um, or as you in regards to the soft landing. But I want to clarify what a soft landing actually means, right? Because a lot of people don't understand. They believe that the fact that we don't or we have positive growth is going to mean that we have a soft landing, right? Like as GDP is climbing or is staying in the positive, oh, it's a soft landing, right? In reality, a soft landing, we're going to need to see unemployment remain low and the labor market remain tight. In turn, with inflation coming under control. So with the
Right.
unemployment market remaining low, which in turn, right, is or I should say, they're one and the same. The labor market being tight is extremely low unemployment, and that along with inflation coming under control is going to be that soft landing that everyone's talking about and everyone's looking for, especially those that are um, kind of YOLOing the dip, right? In equities, they want that soft landing because it'll just vindicate the idea that, oh, look, no recession, stocks to the moon, S&P can go 45, 4,800, 5,000, all this, all these ridiculously high price targets can be met, etc., with a soft landing. Because obviously, if you don't have a soft landing, what you have is a recession, right? And that's not going to be good for any bull outside of the bond bulls.
hmm So
So
right now it seems like that's playing out, doesn't it? Like we've
to a
got a tight
to a
labor
degree,
market. We've got inflation that seems to have peaked. I mean, it seems like bonds are starting to think that inflation has peaked, don't they?
yeah, yeah, to a degree they do. And let's talk about the GDP. So let's look at GDP here. You can see this is the GDP. The orange line is the quarter over quarter real GDP. The the yellow dotted line is the Atlanta Fed now GDP nowcast, which is at 3.76. Last reading 3.2 that was reported. So as you can see, we're still in positive territory, right? We can look back in time, and the positive line is obviously the white line. We can look back at time and say that these numbers are actually quite robust, right? We're not actually seeing recessionary signals here from GDP at the moment. This is another thing that's been bolstering markets. We had these two negative GDP prints back in Q2, Q3 of 2022, and kind of reversed since then. And this has basically been one of the main driving factors in keeping markets off lows because obviously if GDP is not falling apart, well, then it's quite hard to have a recession, right? The actual recession itself, the technical recession, which is two consecutive quarters of negative GDP, has already been eradicated.
hmm
So that in itself is obviously giving us this idea that a soft landing is possible. But I personally, as much as I obviously we have to admire that the Fed is doing the best they can do. They're not recklessly raising interest rates, right? So we're up to 433 basis points, terminal somewhere in the low fives, high 490s, right?
hmm
So obviously this is a year of rate hiking, and we have to also acknowledge that we're in the fastest rate hiking cycle in over 30 years. Okay. So I give them credit for not chasing the tails of inflation even more aggressively and really just destroying the market. They're trying to do their best, but and because of the way that they're acting, it's easy to construe the idea that a soft landing is possible as you look at the economy every day here just via GDP and saying, look, it's not falling apart. But as I always say, or as I've always said, it's not the rate hikes or even the actual Fed funds rate where the Fed is bringing these rates, but it's the duration at which these rates are held at the levels that they're being brought to that will cause issues specifically down the road. And like I just said, that we are in the fastest rate hiking cycle we've seen in 30 years. We're only at 400 basis points worth of rates, not even one rate hiking cycle, right? We've come up 75 basis points from the last like think of how long has this market or economy been in a call it 350 basis points plus Fed funds rate environment.
Yeah, it's been a while. So like there's been a lot of time for the market to price everything in.
Oh no, what I meant to say was how long I must have misphrased it. How long have has this economy been sitting in an actual 350 basis point environment where the Fed funds rate was actually above 350 basis points.
Oh,
And
well,
if we,
yeah, it hasn't even been
yeah,
that long.
right, that's what I'm trying to get at.
But I
So
mean, like the terminals have been priced in for a while now.
that's true. But there's also even the terminals, right? The terminals haven't been priced. If we go back 12 months from now, right? The terminal wasn't at 500 basis points.
All right. Yeah, that's true.
That's where I'm trying to go with this. But yeah, you're right. Essentially, I know what you're saying. Yes, you're right in the fact that the market has been ahead of the Fed the entire time. So essentially, it's been longer than where the Fed funds rate has been. But in terms of actual terminal pricing or rate pricing, right? It's been less than 12. It's been about 12 months.
Hmm.
You know, they were expecting something off the rip of like the Fed peaking at like 100 basis points
Yeah.
originally.
Yeah, I remember all
Okay.
the analysts' forecasts. Every time they
Yeah.
hiked, they're like, "Okay, that's the peak."
Yeah, right. And since then, obviously, we've blown that. We just went nuclear right through that. But yeah, so that's one of the main drivers there for why or the situation that we're in, obviously with growth, right? The idea that the a driver for the idea of a soft landing. Now, why I don't think a soft landing is going to happen is one, the speed at which rates have risen is faster than we've seen in at least 3 decades. So we're going to need to see those rates sit here for some time to really see those effects bleed into the market. We haven't had enough time for with these rates at these levels to really see how the economy is going to be affected by them. Number
Hmm.
two is the Phillips curve. Now I know we've spoken about this a lot. And for those that don't know, it's a textbook model that indicates inflation and unemployment are negatively correlated, right? So it basically graphs out inflation and unemployment and shows that there's a negative correlation between the two. Higher unemployment equals lower inflation. The model has technically been disproven over the years, and it's primarily due to the weakening correlation with more noise in modern times. So, if we take a look here, before we go back into the GDP chart, what I have on my chart here is I have the Fed funds rate, excuse me, not the Fed, the unemployment rate in blue, and the inflation rate in orange. And on the bottom, I have a 2-year trailing correlation coefficient. So what as you can see here, this correlation or this overall correlation, right, is very inconclusive. It kind of looks like you don't know. There really is no correlation. Sometimes it's up, sometimes it's down, and this is one of the primary drivers in disproving the Phillips curve, right? The idea that they don't remain correlated long enough and steady enough for the model to actually make sense, specifically in modern times. Well, if you take a look at the Phillips curve and we take away all the garbage data, basically all the irrelevant stuff where inflation is irrelevant, we're talking inflation, sub fours, irrelevant times, and we look at these points in history where inflation peaks in aggressive runs, what you'll notice is the Phillips curve is either just coming off of or going back into a negative correlation. And I have that annotated here with the red line. So if we go back in time, all these orange peaks, these are CPI peaks, you'll notice that we're either coming out of a negative correlation or going right back into one. And what that's telling you is that even though the Phillips curve is seen as is not perceived as a statistically strong model, it's when we get to these extremes where the Phillips curve comes to life.
Hmm.
So where I'm getting at is when we see CPI hitting 8-9%, right? This is the point in history where the Phillips curve comes to life, where the correlation is negative, where we're going to need to see that unemployment lift to really fix inflation. And it would be something that if we go look back in time, it would be the first time where we don't see unemployment lift to fix inflation.
Interesting. But I mean, could it happen delayed? Like, could it be a delayed effect? So we see inflation come down and then unemployment rise. A quarter late.
That's exactly how it historically happens.
Okay.
So, so take a look here under the GDP chart. What I have illustrated is the unemployment rate with the inflation rate, and these white arrows, they are indicating unemployment rate peaks. And if you take a look at when unemployment the unemployment rate peaks, it's usually at the end of an inflationary boom.
Hmm.
Me-
Okay.
meaning, meaning, for that inflation to be cured, right? For it to be mended completely, we need an unemployment blowout.
All
And
right.
I mean,
Wait. So likely the scenario that's going to play out is if this is the peak in inflation, we will see unemployment rise, and then the Fed's going to cut, and then that opens the door to a secondary inflation peak.
well, no, that would be the scenario. That would be the 1980 scenario, right? Look, so what
Right.
happened here was inflation was ripping, unemployment went up, and we have the Fed funds rate actually here too in white. I don't want to confuse anyone, so we're gonna we're gonna disable it in a second again,
Yeah.
just to
Can you full
just
screen
illustrate.
that
So,
chart?
yes, I can. Maybe this will be better. Yeah. So, here, let's see if we can disable. Yeah. So here we have the white line being the Fed funds rate and the orange line being the inflation rate. What happened in 1980 or the late 70s, early 80s was the Fed cut real quick as inflation fell, and they didn't leave enough time with rates at their peak to be absorbed into the economy to cure this inflationary issue. The issue persisted. So what ended up happening was inflation actually picked up off the lows and headed higher, and the Fed had to chase inflation again, ultimately putting the Fed funds rate well above the rate of inflation to really just knock it down completely. Now, if we look at the unemployment rate actually spiked both times as well. And let's take off the Fed funds rate. So, what's going on here is that once inflation goes and starts rolling over, it's usually then when unemployment starts accelerating
Mm-hmm.
at that time. So if we're really going to see a peak in, or if we have seen the peak in inflation, a rise in unemployment is almost imminent. Now, this will put to bed the idea of a soft landing, right? Because remember, the concept of a soft landing is we're going to need to see unemployment remain low as inflation comes down. But historically, that has never happened, right? And you can say, going back to here, for example, right, this inflationary spike, and we came lower. Unemployment didn't actually go up, right? But we are also coming off a different. So here, for example, unemployment was collapsing, inflation was ripping, but inflation was negative. We're talking 2.45
Right. So
going
that's just
into
a
that move
completely different situation.
environment. Yes,
Yep.
yes. Historically, where inflation is running away or somewhat ran away, unemployment needs to go kaputskis to fix the situation. And obviously, there are delays to this, and that's what these red boxes are describing. If we go look at these red boxes, you can see that in 91 it took inflation to go down quite a bit to see the peak in unemployment. But it's kind of one wagon sets in motion the other, right? So this move in inflation is going to push a move into unemployment, but it's not going to happen simultaneously. So again, in 2000s, inflation peaked in 2000, unemployment rate peaked in 2003.
Mm-hmm. Right. But you can see unemployment start moving upwards shortly after inflation peaks. So we could
Right.
likely expect unemployment to start increasing shortly, especially if this next CPI print is even lower, further confirming a possible peak. A
Yeah.
quarter or maybe halfway through this year, we might start see unemployment picking up.
Yeah, I mean, let's just take a quick gauge, right? Historically, I mean, this is like something really linear to look at, but it's interesting, right? So we have CPI at 8.2%. The last time CPI was here, the unemployment rate was at 8.5%. Now I know, listen, the jobs. This was 1981. We're talking. The jobs market has evolved so much. Maybe company leverage is different. Social capital is different, right? There's a lot of things that have changed since 1981. The market's much deeper. Regardless, though, we are at a huge difference, something that we haven't seen in a very long time. And I think that the way the labor market's acting, it's enticing the market to the idea, to the belief that a soft landing is achievable. And obviously, again, like I said earlier, this is what we're seeing in equity markets and even bond markets. This idea that bond markets are moving up on the idea. Look, if we let me pull up we have it. You know what? No, I want to pull up the 30-year. This is better. So long-term rates is easier to see this graphically. We're still not seeing a bearish trend here, which would be a bullish trend in bonds, right? We're not seeing a bearish trend in rates. So this idea that we're not going to see a recession is where the bond market's going right now. Now, obviously, we're seeing ZB is up, market's up, but in general, we're not seeing this idea of a recession on hawkish numbers. Because remember, the concept of the way the jobs numbers are going is the lower the jobs numbers are, or the tighter the labor market is, the more the Fed will have to hold rates or either higher them to really disconnect the huge divergent or reconnect the divergence we were talking about earlier. So if we're not seeing rates in a bearish environment, well, then there is really no recession to be worried about. Now, rates are lower. Yeah, some of this could have been trend following, etc. But regardless, this is not screaming. This whole bounce off the lows is not screaming, "Oh, a recession was here." This entire move off the lows is telling us or depicting the idea that the recession is not here. Obviously, the market moving up or chopping sideways moving up and not off and excuse me, not below its prior 52-week lows is again also indicating a recession is not here. And we respect that. We understand what the market's telling us, but the market in general has been telling us stagflation. So that's really what that is. It's a basically the inflationary recession. It's a recession with inflation. So and we haven't seen a real inflationary recession in many years. So many people aren't accustomed to how the market's going to react. And obviously, the way the market's reacting is is what we call the chop, and we've been experiencing that for a while now, and I think that that's going to still persist until we get some type of pivot from the Fed, break in the labor market, which would then lead to a pivot in the Fed. But the break in the labor market would be the early signs. I think that the bond market is going to need that break in labor to really get going to the upside.
Right. And I think that's a wrap.
All right. Well, thank you guys so much for listening. If you have any questions, feel free to reach out to us on Twitter at the Market Radar. We have a free Discord. You can join at our website, market-radar.com.